Greetings, Algo Artisans. We're going to talk about a basic indicator today used by a lot of traders, expert and new. It's called the MACD, and you're probably using it wrong. Just kidding. There are different ways to use it. We're going to give you some tricks of the trade right now. Remember, nothing we say is investment advice. Please pause and read this disclaimer. Okay, so we're looking at the MACD on the screen with the euro versus the dollar. And the MACD is an oscillator, right? So it goes back and forth and it has a zero line cross. And so basically we have two different things we look at with the MACD. So let me blow this up on the screen. The zero line is where this red meets the green. And I put this yellow horizontal line on the zero line so it's easy to see there. And now that you've seen it, we'll go ahead and take that off. And of course you do have where this orange and this blue cross each other. So let's talk about the orange and blue. These are the moving averages that make up the name moving average convergence and divergence, right? So the blue is the faster moving average, the orange is the slower moving average, and these are moving averages very similar to what we saw on the EMA video that we talked about earlier. So similar function, very similar DNA, if you will. We can actually use those crosses to talk about when to trade, right? In this case, if the blue crosses below the orange, then this can be a time to look at possibly going short, right? And if the blue crosses above the orange, we can look at this as a possible time to go long. So here's a short, here's a long, here's a short, here's a long. Let's see what that looks like on the chart just with these examples. So if I stretch this out a bit here and we see that there is a short opportunity right here, well, price does go down, doesn't it? And this is on the 30-minute chart. There is opportunity to make money. As the blue crosses above the orange, price goes up right here. As the blue crosses below, price certainly goes down. As the blue crosses the orange upwards, you do see a slight uptick in price. And then of course, as the blue crosses below the orange right here, you actually see a pretty strong movement down that extends beyond what we can see here. So pretty reliable over time. Now, of course, this doesn't always work. What you're looking at is the kind of market in this snapshot of the market where this does work more often than not. Usually it's going to work better in one direction or the other based on some things that we're going to talk about later for the private members. So the other way we can take a look at how to use this tool is to use the zero line cross. And you can use the blue or the orange. And the blue is going to be less reliable but faster. You get into your positions quicker. The orange is going to be more reliable where you don't get in as early. And again, just like any other way of trading, none of it is always reliable, right? So we can take a look at this example right here where you see the blue cross below the zero line. You could use the orange as well. We'll just use the blue for these examples. If I'm ever going to do zero line crosses, I tend to use the blue. I like to take a little bit more risk and get in earlier. And again, this is not always going to work, and there are ways to filter out the bad trades, but we're just going to use a pure example in this case. Keep it very simple. So you have a cross downwards and price goes down. That's a successful trade, especially if you held on to it for a little while. There's a small success in this trade right here as it crosses up. Another cross up. Price certainly goes up. It goes down on the way up. So, maybe this wasn't such a great trade. So you can see that this is another way to look at it. And as a matter of fact, the way I would properly say this, rather than talking about a cross, I would say that when the blue and the orange are below the zero line, price tends to be bearish, and when the blue and the orange are above the zero line, price tends to be bullish. That's probably the more accurate way to say that, and because we can look at it that way, we can actually combine these two aspects of trading and say if we get a blue and orange cross while these averages are below or above, then we can have kind of a double whammy, if you will. For example, let's take a look at here. Moving averages are below the zero line. Starting right about there, if you look closely, there are a couple of crosses downwards, right? There's a bearish cross right here, and these are both below the zero line. So price is bearish in general, and you get a bearish cross. This is combining these two aspects of the trade. And this gives us another opportunity to enter a short where price actually heads down a bit. Whether or not it's a short you want to take, you need to test and figure out if that works for you. But over time, this short does pay out. And one could use this as a filter where maybe you're using the EMA crosses as your way to enter trades. However, maybe you're only going to take bearish trades when it crosses below the zero line, and you're only going to take bullish trades when it crosses above the zero line. So for example, for this area of price, from here all the way to here, the moving averages are above the zero line. You can see that below where the blue and the orange are above the zero line. Therefore, I could have a rule to where if I see a bearish cross, I don't take the trade. For example, we see a bearish cross right here, and we can see it's not that great of a trade. As a matter of fact, fact, price picks up right after that, and you see a bullish cross directly after that. In this case, a pretty strong trade right there. Very strong move up. So you see here, now you have your bearish cross up here, and over time that trade would pay out. However, whenever you see a bearish cross below the zero line, you might be able to test and say, hey, you know what, maybe depending on this asset, depending on this time frame, it's better if I only use these MACD crosses under certain circumstances, perhaps whether or not it's below or above the zero line. And that is going to vary. It's going to vary greatly, because what you'll notice also with MACD is that the farther away the cross is from the zero line compared to the rest of the chart, those tend to be better trades, right? So for example, this right here, this cross that's a bearish cross, it is above the zero line, not a whole lot of room to go down. There's some win right here, and there's a decent win right here, and you can see you're having a series of these happen in a row where price is really fighting to make a move. So what you want to do is use some different techniques, maybe, where you can figure out whether or not these crosses are trades you want to take. Again, one of them could be whether or not it's above or below the zero line. However, we do have a little bit of secret sauce that we're going to do here for our private members only. They're going to help us understand how we can filter out some of the bad trades. Now, before we get to the secret sauce, we're going to talk about the histogram, because the histogram are these lines right here, these bars. And what's important about these bars is they are illustrating the change in trend on these MACD crosses. They actually predict the cross before it's going to happen. Now, they don't always work, because sometimes you see the colors change and the cross doesn't happen and they flip back. So we don't want to rely on these too much, but these histogram color change is an early indicator that there is going to be an MACD cross. And that does give traders with the right kind of filters the opportunity to maybe get in the trade earlier and get more risk to reward, better R's, putting in less money to pull more money out. Now, why do these histograms color change? How do they even work? Well, it's really simple, actually. All it is the distance between the orange and the blue. So if I were to just draw a line right here between the orange and the blue, a straight line down, you'll notice that that's exactly the length right below of the histogram right here. So that's all it is measuring the distance between these two. And as that distance expands, price is getting more and more, in this case, bearish. Here you see the distance expanding and it's getting more and more bullish, right? And then as this distance contracts, you'll notice that the blue is actually getting a little bit closer to the orange, and the speed at which they're expanding is actually slowing. That's an indication that price is going to flip in the other direction. So we can use these tools to our advantage, understanding that, okay, they're starting to get closer, the expansion is happening at a slower rate, and it gives us a graphic representation of that, because staring at these lines right here might not give us all the data we need. And also, histograms can be used in a divergence. A really good example of a divergence, and this would be a bullish divergence. So in this box, you'll notice that the histogram itself, those red lines, it dips down low, it peaks just above, you get one little green guy right there, and then it dips again, but a very, very small amount. And what you'll notice is that with price, the price will continue down. That's what creates this divergence, right? So you have the histogram divergence where you have what I just described, while price continues to head downward during that whole period, especially at those peaks. Let's display that graphically here. We'll go back to our MACD up close. So at the peak here of the histogram's depth, you draw it to the next peak, and you notice that that's an upward line. When you look at the price, it's the opposite. It's a downward line. That's called a divergence. And it's extremely predictable when you see a histogram divergence, especially when the depth of this is twice as deep as the next line, right? So you can measure that using our tool here. So this is a sixth of the other, right? So that's way more than twice. Instead of a times 2, that's a times 6. It's a very nice divergence to play. And because it peaked over the zero line just for this one little tiny candle right here, that little tiny histogram bar, once this starts to flip over towards the zero line, the price of whatever you're looking at is probably going to go up, and it's a pretty high probability. This is a great tool, and sure enough, you see it right here, where it ends pretty much right here, and price makes a nice move up. That's a nice winnable trade. This is on the 30-minute time frame. That's a lot of pips here. It's a lot of distance to make money. So these tools are just wonderful tools. MACD is great, and that's all we have here for the public to view. I'm going to jump over to the private right now and show some of the secret sauce. I hope this video was helpful. Please come over to algofactory.tech. We teach people how to build their own trading method, otherwise known as an algorithm. You don't have to know how to code, but if you do code, we can put you on the path to where you can build something that trades for you while you're not at the computer. If you just want to trade manually, which is what most people are doing, then that is, of course, something that we can help you do and help you have the capability to possibly extract money out of these markets on a regular basis. And while we do focus on crypto for a lot of these videos, I'm actually primarily a Forex trader, and you got to know that crypto doesn't go forever. it goes for about a year, year and a half, and then for a couple of years, there's not much going on in crypto. And if you want to be a trader, you're going to want to understand how to really trade, how to put on those big boy pants, because what's going to happen is eventually crypto's going to flatten out and the meme coins aren't going to be what they used to be, most likely. I've seen it enough times and been in this game since 2017. I don't expect that to change. So come on over, learn how to trade. As a matter of fact, we got some pretty happy customers who are already down the path of success in their algo building. Let's hear from one of those right now.
This is Think Free's Algo Factory Testimonial. I began my prescription for Algo Factory the summer of 2023. I am now 70 years old and I have set a goal to have a supplementary income by learning to trade. I have been putting in about 3 to 4 hours per week of study time. In spite of this small time of commitment, I am determined to learn to trade. I set a goal of slow, steady progress in my learning. It is now March of 2024, and I have been delighted that through the articulate speech and hands-on help and support from Cowboy, I have developed an algo that looks very promising. I've come to appreciate Cowboy's remarkable ability to communicate and teach. He's not just knowledgeable, but also very creative in his shoot-from-the-hips approach. I wonder, is that where the name Cowboy came from? I have followed the Algo Cowboy and V the Guerrilla Economist for more than 3 years and have found them to be very respectful, caring, and firmly rooted in reality. By that I mean they have a clear, deep, no-nonsense understanding of the world we live in, not just in trading and economics, but geopolitically and, dare I say, spiritually as well. For me, this fact makes working with them all the more gratifying and secure. This has and continues to be a great investment of my time and money. Also ends up being fun with the humor that is shared amongst our Algo Factory group members. Thank you, Cowboy.
AlgoFactory.tech. Trade your job, upgrade your life, and we'll see you on the next one.